Hello friends, today we'll talk about tools you'll hear about literally everywhere. They're featured in training videos and mentioned by experienced traders and newbies alike. And the MACD falls right into this category. It's an indicator whose name is familiar even to those who don't fully understand how it works. Everyone uses it differently. For example, as entry confirmation, a filter, or the foundation for the entire strategy. Why is there so much talk about the indicator? And why, despite the emergence of hundreds of new tools, does the MACD remain a stable of countless traders? The answer is that it reveals the market's internal dynamics, whether it's accelerating or decelerating. Before we begin to analyze how the MACD works and what signals it generates, it's important to take a step back and understand where it comes from, who invented it, and why, and the original idea behind it. Because without this, the MACD will remain simply two lines and bars. So let's start at the very beginning with its history, and then move step by step into practice and a real-world application. The MACD indicator was developed in 1979 by Gerald Appel. Initially, the indicator consisted of two moving averages, but in 1986, Thomas Asprey added a histogram, making the MACD more accurate. It stands out for moving average, convergence, divergence, which translates the indicator's concept is ingeniously simple yet effective. It combines two exponential moving averages, the EMAs, of different time frames, one shorter and one longer. The difference between these two EMAs is displayed on a separate chart known as the MACD line. A signal line is also added. When the MACD line crosses the signal line, it's considered a bullish signal and indicates a good time to buy. When the MACD line crosses below the signal line, it can be interpreted as a bearish signal, indicating a good time to sell. But the indicator's essence goes beyond line crossovers. It can also be used to identify divergences. A bullish divergence occurs when the asset price makes lower lows while the MACD makes higher lows. This suggests that the downtrend may be losing steam and a bullish reversal may be on the horizon. Conversely, a bearish divergence occurs when the price makes higher highs while the MACD makes lower highs, indicating a possible bearish reversal. Combining the MACD with other indicators allows us to increase the accuracy of the signals and reduce the likelihood of false entries and exits. The MACD itself is a trend and a momentum indicator, showing price dynamics through the difference between moving averages, but when combined with other tools, it becomes more informative. One of the most common approaches is to use the MACD in conjunction with the RSI. While the MACD shows trend direction and moments of acceleration or deceleration, in price movement, the RSI helps identify overbought and oversold zones. For example, a MACD buy signal will be more reliable with the RSI is also in the oversold zone, and a sell signal will be more reliable if the RSI zone is in the overbought zone. Another popular option is combining the MACD with the moving averages or EMAs. The MACD itself uses exponential moving averages for its calculations, but additional lines on the price chart help visually confirm trend and identify support and resistant levels. Entries based on the MACD signals in the direction of the main trend, confirmed by the moving averages, are considered safer. But to avoid much theory, let's look at how this works in practice. I suggest trying several trades using three different indicators, one of which, of course, is the MACD. Great. Now, let's get started. Our first analysis tool is the EMA indicator. A moving average, essentially, it's a line that smooths out the price movement and shows the overall market trend. On the AUD and the CAD OTC chart, we notice a situation where the price, after a gradual decline, begins gradually to slow and prepares for a reversal. This is clearly confirmed by the interaction of the two lines, the 20 EMA, the yellow one, and the 50 EMA, the blue one. When the faster line, the 20 EMA, crosses the slower line, the 50 EMA, from the bottom to the top. This often interprets a signal of possible growth. As a result, the price movement actually meets expectations. The position closes positively. Deal 2. Now, let's move to the RSI indicator, the Relative Strength Index. It's important to understand that the indicator works best when price quickly approaches these levels, but doesn't linger there for too long. If the signal tramps in one zone, the likelihood of it working out decreases. In our example, we're analyzing the USD and IDR OTC asset. The price breaks over 70, indicating that the market is overheated upwards and downward correction is likely. For a trader, this is the perfect moment to act. We open a trade down to $50, and the price indeed declines. Ultimately, the position closes in the black. This example shows the RSI indicator helps you spot overbought conditions in time and avoid going against the tired market. 3 deal. For the third trade, we'll use the MACD indicator. As we discussed earlier, its purpose to show the balance of power between buyers and sellers is based on moving averages and allows us to spot trend reversals. On the chart, the same asset, USD, IDR, the MACD lines begin to intersect downwards. The green and red lines form a characteristic movement. The green line interacts with the red line from the top to the bottom, which is often interpreted as a signal for a decline. For a trader, this is a good confirmation. Market is poised to move lower. Based on this analysis, a trade of $50 is opened in the downside. Once again, the price action meets our expectations. The position closes positively. These 3 examples clearly demonstrate how indicators can help better understand what's happening in the market. The EMA shows where the market is heading overall, the RSI tells you whether it's overheated or underheated, and the MACD helps you spot when the trend might change. But the most important thing is to be able to read these signals correctly and see the whole picture. Today, you learned how the MACD indicator came to be and why it's become